current liabilities. One type of current liability you can have is you can borrow money on a short-term basis. That means that you're going to repay that loan within 1 year. Now, let's go through the various types of entries you could have with borrowing a short-term note payable. Our facts are that we're going to borrow $10,000 for 90 days. Now, we need to come up with an interest rate. Well, to make it easy on ourselves, let's assume an awful interest rate of 12%. So we're borrowing this money for 90 days, 12% note. Now, when we borrow the money, this is what happens. We're going to be debiting cash because we'll receive $10,000 cash, and we're going to credit note payable, which I'm abbreviating NP, for $10,000. Okay? 90 days later, when I repay that note, I know that I'm going to be debiting note payable for $10,000, but I'm also going to have to pay some interest, aren't I? So that's going to be a debit to interest expense because I have to pay for the privilege of using that $10,000. Now, more on how to get this interest expense in a second. The third thing I know I'm going to do is I'm going to credit cash for what we call the maturity value. The maturity value is the principal, the $10,000, plus the interest. So how do we come up with interest? Well, interest is simply, and I'm going to do it on the next page. Interest is always computed. Principal times the rate times the time. Now, this interest expense says that we have a principal amount of $10,000. We had an interest rate of 12%, and the time, since it's for a year, 365 days, and we borrowed this note for 90 days, it's going to be 90 365ths. So principal of $10,000 times 12% interest times 90 days, the length of the note, over how many days are there in a year? 365. So the interest expense on this note is $295.89. $295.89. Isn't that exciting? So when we make that journal entry to repay the note, it's going to be debit note payable for the principal. It's going to be debit note payable for the interest, $295.89. Yes. Yep. And the cash is going to be credited for the maturity value, the principal plus the interest, or $10,295.89. Now that's a straight borrow, repay, all within 1 year. But generally what happens is that we borrow the money, our year end is smack dab in the middle of it, and then we repay it in a following year. So let's take a look at how that happens. So let's say we borrow the $10,000, then 30 days later is the year end. And because this is a 90-day note, what's going to happen? Well, then 60 days even after that, we're going to repay it. So when we borrow the $10,000, it's still debit cash, $10,000, credit note payable, $10,000. 30 days passes, it's now year end, and we have to include this year what we owe for this year, and so we've accrued interest through year end, which means that it's debit interest expense and credit interest payable, because we're not paying it, we're just recognizing our legal obligation, the estimate. So how do we get this? Well, it's the principal of $10,000 times the interest rate of 12%. And how many days have passed? 365ths. So the amount of the interest expense here is $98.63. So that's accruing through year end. We go through our closing entries, the interest expense goes away, the interest payable stays. So 60 days later, when we repay it, it looks like this. We're going to have interest expense for 60 days worth of interest. We're going to have a debit to interest payable for the 30 days that was in the previous year. We're going to be debiting note payable for the principal of $10,000, and we're going to credit cash. These are all debits for the maturity value. And you'll remember that maturity value was $10,295.89, same amount. The interest payable is for the $98.63, which is 30 days of interest, and the interest expense is for $197.26, the principal times the rate times the time for 60 days. That's it.